Whenever we open a trade, we hope that we are correct. We don't know, but we hope, given all of our analysis, that we've made the right decision. As the trade develops, we become more confident that we've made the right decision. And eventually we reach a point where we are certain that we've made the correct decision. In the past, we've relied to a significant extent on price volatility to help us to decide when each of those points has been reached. In volatile markets, this is no longer appropriate. What we need to also understand is trend volatility. Fractional repetition is the gradual development of behaviour across different time frames. You may remember the original screensavers that were created by Mandelbrot, and they were based on Mandelbrot fractional repetition. The screen gives you an example of how this develops. Look at screen 1. Look at the little yellow square. Screen 1 looks like it's a complex situation, it's a complex pattern. But if we take screen 1, that little square, and develop that, expand that into screen 2, then we can see that. So this is the standard GMMA display that we see on charting programs such as Guppy Traders Essentials. What we're looking at is 2 groups of moving averages and 3 sets of relationships. The long-term group is shown by the red lines. And what we're particularly focused on is the degree of separation or compression that takes place in this long-term group. The blue group shows short-term trading behaviour, and we use this to track the behaviour of traders. Again, we see the compression and expansion behaviours within this short-term group. This tells us the level and degree of trading activity that's taking place. It shows how traders take short-term profits. So for instance, what we're looking for is the entry minute. The entry minute is defined as a price bar or a candle that rapidly moves beyond the volatility range of all the previous price candles. So if you look at the chart, we can see that price activity has been more or less confined in a reasonable level. But when we see the entry minute develop, we can see that this is moving much more rapidly, that the momentum is behind it, and that this candle will be substantially larger at the end of this 1 minute time frame than all the candles that preceded it. Then we move to a situation of certainty. Certainty tells us that we can be much more certain that our trading decision is correct. There is a very, very low probability of a trend change developing or of a sudden trend change developing. It gives room for much more individual price volatility that is still consistent with the long-term underlying trend. How do we determine that situation of certainty? Again, the break-even line is the critical reference point. When the value of the lower edge of the long-term moving average is equal. The key feature is that we must enter on a momentum minute in the direction of the 3-minute trend. In other words, if the 3-minute trend is up and we're looking to go short, and we have a 1-minute severe downtrend, it's not an entry signal. What we want is the 1-minute momentum to be moving in the same direction as the 3-minute direction. The essential feature. So the objective with countback line is to enable an entry at the best point of the trend to, first of all, confirm the trend break, to define significant price volatility and the volatility limits. We take the lowest low in the current downtrend. We move to the top of that bar, across to the left to the next highest bar, up that bar, across to the left to the next highest bar, to the top of that. That's the 3rd bar, the 3rd significant bar, and draw a line to the right-hand side. That's the countback line. So the key feature is that we must distinguish between price volatility and trend volatility. If we use price volatility by itself, then it will generate a range of false signals. The correct way to use price volatility is to use it as an alert signal, and then to apply GMMA trend volatility management as the confirmation signal.